Good day. We are the Group 6 of BSA 3B, and today we're going to discuss the comprehensive problems of chapters 33 and 34, starting with the share-based payment and to be followed by the book value and earnings per share. You are engaged in the first-time audit of God's Love Company. God's Love Company reports its shareholders' equity as follows on December 31, 2020. Ordinary share capital of 50,000 shares at 100 pesos par, which has 5 million pesos, share premium of 1 million pesos, and retained earnings of 10 million pesos. On January 1, 2019, granted share options to its 300 employee working in the sales department. Additional information and transactions on January 1, 2021, the historical balances of the land and building of God's Love Company are: the land costs 10 million pesos and the building costs 60 million pesos with an accumulated depreciation of 18 million pesos. The land and building were appraised on same date and the revaluation revealed the following. So the revaluation value of land is now 15 million pesos rather, and the building is now 17 million pesos. There were no additions or disposals during 2021. Depreciation is computed on straight line. Estimated life of building is 20 years. On April 1, sold 25,000 ordinary shares at 105 pesos. On May 1, purchased 10,000 ordinary shares at 102 pesos to be held as treasury. On August 1, the company declared a 4 peso per share dividend to the shareholders of record August 30, payable on September 5. On September 15, the company sold 6,000 treasury shares at 110 pesos. The unadjusted net income for 2021 was 5 million pesos before taking into consideration in the effect of share-based payment. Upon investigation of the share-based payment, the following information were noted. On January 1, 2019, God's Love Company granted the share options to each of 300 employees working in the sales department. The share options vest at the end of a 3-year period provided that the employees remain in the entity's employ and provided the volume of sales will increase by 10% per year. The fair value of each share options on grant date is 30 pesos. If the sales increase by 10%, each employee will receive 200 share options. If the sales increase by 15%, each employee will receive 300 share options. On December 31, 2019, the sale increased by 10% and no employees have left the entity. On December 31, 2020, sales increased by 15% and no employees have left. On December 31, 2021, sales increased by 15% and 50 employees have left the entity. No options were exercised yet as of the end of 2021. Since the inception of the share-based payment, no journal entries have yet been provided by the company. To summarize the problem, given information as of December 31, 2020, ordinary share capital of 5 million pesos, share premium 1 million pesos, retained earnings 10 million pesos. Additional transactions in 2021, land and building, land from 10 million pesos to a revaluation value of 15 million pesos, building from 60 million pesos, which has an accumulated depreciation of 18 million pesos, to a revaluation value of 70 million pesos. Depreciation is calculated on straight line basis over a 20-year life. April 1, sold 25,000 ordinary shares at 105 pesos each, par value of 100 pesos, share premium of 5 pesos per share. May 1, purchased 10,000 shares at 102 pesos each as treasury shares. September 15, sold 6,000 treasury shares at 110 pesos each, par value of 100 pesos, share premium of 10 pesos per share. Dividends declared a 4 peso per share dividend to shareholders on record as of August 30, payable on September 5. The company's net income for 2021 was 5 million pesos before considering the effect of a share-based payments. The company granted share options to 300 sales employees. The vesting condition includes employees must remain employed for 3 years, sales must increase by 10% per year for 20 options or by 15% for 300 options. As of December 31, 2021, sales increased by 15%, 50 employees left, so only 250 employees remain. Question number 1. The depreciation of the building for the year ended December 31, 2021 should be A. 5 million, B. 2 million, C. 3 million, and D. 3,500,000 pesos. So the given datas are building costs, which is 60 million pesos. The revalued amount or the revaluation cost is 70 million pesos, and the useful life is 20 years. So it including the accumulated depreciation of 18 million pesos. So to solve the depreciation expense, we must first solve the remaining useful life of the building because of the accumulated depreciation. So the formula of the remaining life is the total life minus the accumulated depreciation, which is 18 million pesos, divided by the original cost, 60 million pesos, and multiplied by the total life of 20 years. So we can get the answer of 14 years remaining life. Now, we can get the depreciation expense but with the formula of replacement cost or the revalued cost, which is 70 million pesos, divided by the remaining life, which is 14 years. So we can have the answer of 5 million pesos. So the depreciation of the building for the year December 31, 2021 is 5 million pesos. Letter A. Question number 2. How much is the compensation expense that should be recognized for 2021? Letter A, 1,200,000 pesos. B, 2,250,000 pesos. C, 900,000 pesos. And D, 450,000 pesos. So the given datas are in January 1, 2019, granted options to 300 employees were each employee gets 200 options if sales increase by 10% and 300 options if sales increase by 15%. Sales increased by 15% in 2021 and 50 employees left. Fair value per option is 30 pesos and total vesting period is 3 years, which are 2019, 2020, and 2021. So to compute for the compensation expense, we must subtract the cumulative expense of the current year to the cumulative expense from the previous year, where the cumulative expense of the current year are the number of employees expected to vest in this year, multiplied by number of options per employee, times the fair value per option, times the fraction vesting period completed. So the cumulative expense in 2019 is 300 employees times the 200 options because of the sales increase of 10%, 30 pesos fair value, and multiplied by 1/3 because it is the first vesting period, which we could get 600,000 cumulative expense. In 2020, 300 employees multiplied by 300 options because the sales increased by 15%, times the 30 pesos fair value, and times the 2/3 because if it is the second year of vesting period. So we can get a cumulative expense of 1,800,000 pesos. So to get the compensation expense for the 2020, we must subtract 2020 cumulative expense minus by the 2019 cumulative expense. So we can get 1,200,000 pesos. So in 2021, we multiplied 250 employees because there are 50 employees left in 2021. So it is deducted. That's why it only has 250 remain, multiplied by 300 options because the sales increased by 15%, times the 30 pesos per value times the 3 of 3 vesting period, which we could get a cumulative expense of 2,250,000 pesos. So to get the compensation expense, we will subtract the cumulative expense of the current period, which is 2,250,000, and the cumulative expense of the previous period, which is 1,800,000, which we could get 450,000 pesos compensation expense. So The answer for number 2 is letter D, 450,000 pesos. Question number 3. How much is the adjusted ordinary share capital at the end of 2021? Letter A, 5 million pesos. B, 7,500,000 pesos. C, 7,625,000 pesos. And D, 7,100,000 pesos. So the given datas are the beginning balance of 5 million pesos, par value issued of 100 pesos, and new shares issued 25,000 shares. So to get the adjusted ordinary share capital, we will add the beginning balance plus the new shares issued multiplied by the par value. So the new shares issued is 25,000 multiplied by the par value of 100 pesos. We can get 2,500,000 pesos new shares issued at par. So to get the adjusted ordinary share capital, we will add the beginning balance, which is 5 million pesos, plus the 2,500,000 pesos new shares issued at par. We can get a sum of 7,500,000 pesos. So the answer for number 3 is letter B, 7,500,000 pesos.
So hi, I am Mariela Belmonte and I'll be continuing for the question number 4. So how much is the adjusted balance of share premium end of 2021? So here's the solution. In a given data, there is a beginning share premium of 1 million pesos and a sale of 25,000 shares at 105 pesos, a premium 5 pesos per share, and a sale of 6,000 treasury shares at 110 pesos, and it is a premium of 10 pesos per share. So to come up with the answers, here's the formula. Share premium equals beginning share premium plus the new shares issued times premium per share, and add the treasury shares reissued times premium per share. So in calculation, to get the answer of a share premium, first we need to get the answer for the share premium from issued shares. So we multiply 25,000 times 5 and we get the answer 125,000. And next is to get the share premium from reissued treasury shares. We multiply the 6,000 times 10 equals 60,000. So in a total adjusted share premium, we add the 1,000,000 to 125,000 plus 60,000 equals 1,173,000. So the answer there is letter C. Again, the answer is 1,173,000. So question number 5. How much is the adjusted treasury share at the end of 2021? So in the solution here is there's a given data, which is the purchase 10,000 treasury shares at 102 pesos and a sold 6,000 treasury shares at 110 pesos. So here's the formula. Treasury shares ending balance equals the beginning treasury shares minus the cost of the treasury shares sold. So in calculation, we go first for the answer of the cost of treasury shares. So the 10,000 times 102 equals 1,020,000. And next is to get the cost of sold treasury shares, which is the 6,000 times 102 equals 612. And a treasury share balance ending is we multiply the cost of treasury shares, which is the 1,020,000, and minus the cost of sold treasury shares, which is 612,000, equals 408,000. So the answer here is letter D. So question number 6. How much is the adjusted balance of unappropriated retained earnings at the end of 2021? So in solution, in a given data, there is a beginning retained earnings of 10 million pesos and a net income, which is the before share related payments, of 5 million pesos and a share dividends of 4 pesos per share, and the outstanding shares, which is the initial, which is the 50,000, the new shares issued of 25,000, which is total of 75,000. So in formula, ending retained earnings equals beginning retained earnings plus net income minus dividends minus compensation expense. So in calculation, we get first the dividends expense, which is the 75 times 4 equals 300,000. And next is the share-based compensation expense equals 450,000. So the adjusted retained earnings here equals the 10 million plus 5 million minus 300,000 minus 450,000. Then we get the answer, which is 13,482,000. So the answer here is letter D. So here's another comprehensive problem. So you are engaged in the first-time audit of the financial statement of Gina Claire Company, which began operations in 2020. The following ratios and the other data pertaining to the financial statement of Gina Claire Company for the year ended December 31, 2021 were provided to you by the company accountant. So from the statement of financial position, there is an ordinary share capital of 10 pesos, of 1 million pesos, and a share premium of 500,000 at a retained earnings in December 31, 2021 of 1,800,000. And then computed ratios, which is the basic earnings per share of 5 pesos and the book value per share, which is 33. And the additional information here is first is the 2020 ending inventory was overstated by 50 pesos. And here's the additional information. One is the 2020 ending inventory was overstated by 50,000, and the accrued expenses at the end of 2021 amounting to 30,000 pesos were not recorded. And the sale of merchandise on account in 2020 for 45,000 pesos was erroneously recorded in 2021. And next is the 1-year insurance premium of 48,000 effective for August 1, 2020 were charged to expense in 2020. And the accrued expense on note receivable at the end of 2020 in the amount of 5,000 was not taken up at year end. And next is the unearned rent at the end of 2021 was Next is the unearned rent at the end of 2021 was understated by 20,000, and the sales on account in 2021 includes the interest income of 1,000, and the collection of accounts receivables for 2,800 was not recorded at the end of 2021. And lastly, there is a no share issuance was made during the year. So now, here's the adjustments. So, the ending inventory overstated in 2020, decrease of 50,000 from 2021 cost of goods sold, and the next is the accrued expenses not recorded, increased expense by 30,000, and the sales on account in 2020 erroneously recorded in 2021, which is decreased sales by 45,000. And the insurance premium charged to expense in 2020 decreased expenses by 12,000 of 08/01 of 48,000. Accrued interest on notes receivable not taken up at year end in 2020, which is increase in interest income by 5,000. And the unearned rent understated in 2021, which is increase in earned rent by 20,000. And the collection of accounts receivable not recorded, which is increased cash and decreased accounts receivable by 2,800.
So in my part, I will be presenting the financial adjustment for Trina Claire Corporation and how they affect the net income and retained earnings for 2021. The goal is to determine the correct net income for 2021 and the retained earnings as of December 31, 2021 after applying necessary adjustment based on financial errors. So background of the Trina Claire Corporation began operation in 2020. After reviewing the financial statements, errors and unrecorded transactions were identified. This adjustment ensure accurate financial reporting. So, sa given information before adjustment, an adjusted net income is 500,000 sa 2021 and adjusted retained earnings is sa December 31, 2021 natay 1,800,000. So, adjustment, we need to adjust this errors in financial kay magkakos manig interpretation sa company's performance, and corrections are needed to ensure the financial statements accurately reflect the company's actual financial status. So sa adjustment in the inventory overstatement in 2020, so decrease of 50,000 from COGS 2021. Accrued expense, what the record, increased expense by 30,000. Sales on account, erroneously recorded, so decreased sales by 45,000. Insurance premium charged to expense in 2020, so decreased by 12,000. 8 divided by 1 of 48. Accrued interest not taken at the year end 2020, so increase interest income by 5,000. Unearned rent understated sa 2021, so increase by 20,000. Collection of accounts receivable not recorded, so increase cash and decrease accounts receivable by 2,800. So, para makuha natong correct net income, sa 2021, we have the 500,000 nga unadjusted net income. Add up the inventory overstatement nga 50,000 minus 30,000 nga accrued expense, and then less the 45,000 nga sales on account nga what na record ay erroneously recorded in 2021, then 28,000 nga insurance premium, 5,000 sa accrued interest notes receivable, and 20,000 2,800 sa collection of accounts received not recorded. Then total of 422,000. So since the net income was already adjusted 422,000, we must also adjust the retained earnings accordingly. Final retained earnings nato. So din naman tay unadjusted nga 1,800,000 nga koan retained earnings. I-less na to ang 20,000 o 30,000 para kuha na tong final retained earnings nga 1,750,000. So, after all the necessary adjustment, the correct net income for 2021 is mautong 422,000, and the retained earnings as of December 31, 2021 is 1,750,000.
Hello everyone, this is Camille G. Guarte, the one who will discuss further answers in questions 3, 4, and 5. To start with, the question for number 3 is, determine the earnings per share in 2021. So when we say earnings per share, it indicates how much money a company makes for each share of its stock and is a widely used metric for estimating corporate value. To solve for earnings per share, we will divide the net income for 2021, which is our answer from question number 1, that has an amount of 422,000 pesos, by the outstanding shares, 100,000 pesos. So how did we get the 100,000 pesos? We just simply divide the 1 million, which is our ordinary share capital, by 10 pesos, the par value. So 1 million divided by 10 is equal to 100,000, which is our outstanding shares. Therefore, 422,000 divided by 100,000 is equal to 4.22 pesos. Our answer is letter C. Next, for question number 4, determine the total shareholders' equity for December 31, 2021. To get the total shareholders' equity, we just add the ordinary share capital, which is 1 million pesos, the share premium amounting to 500,000 pesos, and its retained earnings, which is 1,750,000 pesos, which is our answer from question number 2. When we add them all, we got an answer of 3,250,000 pesos. Therefore, our answer for question number 4 is letter B. And lastly, for question number 5, determine the book value per share in 2021. When we say book value per share or BVPS, it is a financial metric that shows how much of a company's equity is available for each share of common stock. To calculate for the book value per share, we divide the total shareholders' equity, which is 3,250,000 pesos, by outstanding shares an amount of 100,000 pesos. So 3,250,000 pesos divided by the 100,000 is equal to 32.50. Therefore, our answer is letter B. So that would be all. Thank you.